Red alert recession siren is blaring. The financial world is on high alert. The stock market is a roller coaster with wild swings and unpredictable turns. Right now, it feels like we're on a terrifying plunge with no brakes. Investors are hitting the panic button, scrambling to make sense of the chaos. Why? Two words: recession fears. The dread of an economic downturn is spreading. The economy is showing cracks. Inflation is stubbornly high. Interest rates are soaring, making borrowing more expensive. This has created a perfect storm of uncertainty, and investors hate uncertainty. It's a recipe for market turmoil. We see red across the board. The Dow is down, reflecting widespread concern. The S&P 500 is tumbling, adding to the sense of crisis. Even the tech-heavy Nasdaq is taking a beating, showing that no sector is immune. It's a sea of red, and investors are scrambling for life rafts. But don't panic yet. There are steps you can take. Let's break down what's happening and, more importantly, what you can do about it. This isn't the time to bury your head in the sand. Stay informed and proactive. This is the time to get informed, stay calm, and make smart decisions. Your future depends on it. So buckle up, because we're diving deep into the eye of this financial storm. The domino effect is what I would refer to as the recent events and their market impact. Remember that nasty inflation report last month? It was a wake-up call for everyone. It was a punch in the gut. Consumer prices are still rising faster than expected, hitting everyday folks where it hurts the most: their wallets. This adds fuel to the fire of the Federal Reserve's rate hike campaign. They're determined to bring inflation under control. They're like a boxer relentlessly jabbing at inflation, trying to wear it down. But those jabs also bruise the economy, making it harder for small businesses to stay afloat. Then we got the latest jobs report. Job growth slowed down, signaling potential trouble ahead. Not a knockout punch, but definitely a sign that the Fed's punches are landing. Businesses are getting cautious, rethinking their strategies. Hiring freezes are becoming more common. Layoffs are making headlines, creating a sense of unease. This sends a chill down the spine of investors who are already on edge. Add in supply chain disruptions, the ongoing war in Europe, and you've got a recipe for economic indigestion. The global situation is far from stable. The market is reacting like it just ate a bad burrito with a whole lot of unpleasantness. Investors are scrambling to make sense of it all. Inflation and interest rates are a toxic cocktail. Inflation is a sneaky thief. It eats away at your purchasing power. That means your hard-earned dollars buy less and less. To combat this, the Fed raises interest rates. Think of it like putting the brakes on the economy. Higher interest rates make it more expensive for businesses to borrow money. This can slow down growth and even lead to job losses. It also makes it less attractive for investors to buy stocks. Why? Because their money can earn a better return in safer assets like bonds. This toxic cocktail of inflation and rising rates has investors seeing red. They're worried about corporate profits shrinking. They're worried about a recession. And when investors get worried, they sell. It's as simple as that. Fear and greed, the double-edged sword of investor psychology. The stock market isn't just driven by numbers, it's driven by emotions. Fear and greed are the two biggest players in this game. Right now, fear is winning. Investors are like a herd of spooked gazelles, running for the exits at the slightest sign of danger. When the market drops, fear can become contagious. Investors see others selling and they panic and sell too. This creates a downward spiral that feeds on itself. It's like a game of hot potato, and nobody wants to be left holding the bag. But remember, fear is a bad advisor. When everyone else is selling, that's often the best time to buy, but it takes guts. It takes discipline, and it takes a long-term perspective. Are the global factors fueling the fire? The US economy doesn't exist in a vacuum. What happens in other parts of the world matters. Right now, there are fires burning all over the globe. China's economy is slowing down. Europe is facing an energy crisis. These problems spill over into our markets and amplify our own anxieties. Take China, for example. It's the world's second largest economy and a major trading partner for the US. Their economic slowdown means less demand for our goods and services. That hurts our companies' bottom lines. It's like a giant game of Jenga. When one block gets pulled out, the whole tower becomes less stable. We're all interconnected in this global economy, and right now the foundation feels a little shaky. Let's take a look at geopolitical risks. As if economic woes weren't enough, the world is now grappling with a myriad of geopolitical tensions that are adding fuel to the flames.
We've got a whole lot of geopolitical drama unfolding, and it's impacting markets in ways we haven't seen before. The war in Ukraine continues to disrupt global supply chains and fuel inflation, making it harder for businesses to operate smoothly. Tensions between the US and China are simmering, with trade wars and political disagreements creating an unstable environment. These uncertainties create fear and volatility in the markets. Investors hate surprises and the unknown. Geopolitical events are inherently unpredictable, and they can change the market landscape overnight. They can throw a wrench into even the best-laid plans, causing businesses to scramble for solutions. When tensions rise, investors tend to move their money to safer assets, like gold or US Treasury bonds, seeking refuge from the storm. This flight to safety can drain money out of the stock market and push prices lower, exacerbating the situation. It's impossible to predict the future with any certainty, especially in such a volatile environment. But one thing is certain: geopolitical risks will continue to be a major source of uncertainty for investors, influencing their decisions. The best we can do is stay informed, diversify our portfolios to spread the risk, and be prepared for volatility. By staying vigilant and adaptable, we can navigate these turbulent times. All right, so you're feeling anxious about the market. You're not alone. One strategy is to focus on long-term goals rather than short-term fluctuations. Diversification is key. Spread your investments across different asset classes. Consider dollar-cost averaging to reduce the impact of volatility. Stay informed, but avoid the temptation to react to every bit of news. Sometimes the best action is no action at all. Remember, market downturns are a natural part of the investment cycle. Patience and discipline are your best allies during turbulent times. Investing isn't a sprint, it's a marathon. Historical data shows that markets tend to recover over time. Staying the course even when it's difficult can lead to long-term success. Keep your emotions in check and stick to your investment plan. Understand that volatility is part of the journey. By maintaining a balanced perspective, you can navigate through uncertainty with confidence. In the end, patience and perspective are the keys to weathering market storms. So, where do we go from here? The road ahead may be uncertain, but with the right strategies, we can navigate it successfully. Stay informed, stay diversified, and most importantly, stay patient. Remember, every challenge presents an opportunity. By remaining disciplined and focused on your long-term goals, you can turn uncertainty into success. Thank you for joining us on this journey. Until next time, happy investing.